Dividend growth investing, it just does not work. It cannot possibly work because of inflation. Inflation is out there. It will just eat away at dividends. Dividend yield of many of the companies that I discuss here on my channel is about 3% starting yield. Rate of inflation since the early 1900s on average, it's been about 3%. It can just eat it away. Net net, there's no gain. Game over. Dividend investing does not work. That's a comment that I receive here on this channel sometimes, and I've actually received this comment a number of times, and I wanted to actually do a video today to address this comment. And of course, if you have been following my channel for a while, you know that I absolutely disagree with this statement. Fundamentally, absolutely disagree with this statement. In my opinion, inflation is not a major consideration when it comes to my style of dividend growth investing, at least, because the growth rate of my dividends far outpaces inflation. We'll get to that later. But a lot of people have this mindset, and I think it's human nature to cast doubt, to be skeptical, to create your own roadblocks that might be roadblocks in one's path towards success. It's always good to be self-critical, but sometimes it gets taken a little bit too far, and I feel like a lot of people are looking at inflation incorrectly. And so the purpose of today's video is really to dive into this topic of inflation. I want to talk about it in some detail, and I want to explain how I look at inflation and why dividend growth investing still works despite inflation. And dividend growth investing, by the way, is investing for dividends, for checks that literally come from companies that can be used to pay the bills. And one day, all of my bills will be paid from dividends. Right now, I have a good chunk of dividends coming in, and I can pay a bunch of bills with those dividends. Right now, I choose not to because I'm reinvesting to snowball my dividend stream even further. And so inflation to me is not a game changer. It's not a deal breaker, but I know a lot of folks out there feel that way because I get the comments all the time below. And so let's get started. Let's talk about inflation today. And I can't wait to share why inflation is not a deal breaker for dividend investors. So welcome to the video. Again, a subscriber request. And this one, interestingly enough, is not really a request. It's more of a response to comments that I receive, because most of the comments are pretty matter of fact. They're like, hey, Ian, your strategy is wrong because of inflation. And so I want to address those comments today because I've addressed them in the comments many times. And so I know this is top of mind for a lot of people. And so I'm excited about this video. By the way, if you have not subscribed yet, I please invite you to do so. This is a thriving community, over 9,000 dividend investors strong, supporting each other in our journeys towards receiving passive income. And passive income is amazing. As soon as one gets started with dividend investing and the checks are rolling in from dividends, they can be used to pay bills. Small bills, really small expenses, such as going out to dinner, for example, or big expenses, such as paying for one's rent. And it's such an exciting strategy, and so excited to have everyone here discussing it. Anyways, I want to start with the facts. So inflation. If you look at recent years, inflation more or less is hovering around 2% per year. Here's inflation like 2008 was 0.1%, 2009 2.7, 2010 1.5, so on and so forth. You can read the data here. All of this nets out plus or minus 2%. That's kind of the trading range that we're in. We've been in for recent history. And I like to look at recent history because the world we live in now, it's not the 1970s, it's not the 1980s, it's not the roaring 20s. And so a lot of the inflation data out there people are citing, they're just looking at longer terms, periods of data. So anyways, if one looks at 1913 through 2013, there was a big study done on this online. The long-term inflation rate is 3.22. But this is really skewed because inflation was really high during certain periods like the 70s, the 80s, and 1913 through 1919 was also a higher rate of inflation as well. And so this is not 1913, people. This is 2018. And so looking at data that old, I think it's good. I like to look at old data because when I invest in dividends, I invest forever. I never plan to sell, and I am investing for generations, for generational dividends. And so I think looking at 100 years I have nothing wrong with that, but at the same time, I think it's good to look at both sides of the coin, because recent history does not point to a 3.22. It points to something more in the 2% range. That being said, I'm going to give the historical data the benefit of the doubt. I'm just going to assume, hey, going forward, inflation, it's probably going to be around 3% per year. Fine. So let's then say, okay, this is the data we have. What are we going to do about it? There's a few options out here. There's growth investing. I'm not going to get into that today because this is a channel about passive income and income. So I want to talk about income generation. There's a few options related to income generation. I want to go through two of those today. One of them is getting a job, and one is investing in dividend growth stocks. And obviously jobs are great, and everyone needs a job, myself included, to be able to pay the bills, to save money, to invest in dividends. But I want to look at these because dividend investors eventually have the goal of supplementing or completely covering most of their job income from dividends, whereas someone that's just focused on a job, they're really just looking at, obviously, at the job. Option one, if one gets a job, if you look 1973 through 2017, real wage growth has been 10%, or about 0.2% per year. So let me reiterate that. Wages have been just barely surpassing inflation over that time period. So option one, get a job, you're kind of keeping up with inflation, but not that well. Obviously, there's other options out there, such as starting your own business, being an entrepreneur, all kinds of stuff. But for most people out there, keeping things pretty simple here, job is really how income is generated, and generating income through a job, it's going to keep up barely surpass inflation. So option two, dividends. The area where most people looking at inflation get it completely wrong is they're just looking at the starting yield. They're not looking at yield on cost. So I've done some videos here on yield on cost. I'll link in the description below. One of my original first videos was one about yield on cost. That's how important this concept is to me. Check that out. But the reason people get this wrong is they're like, okay, Ian, a lot of the dividend stocks you talk about, stocks like Pepsi, McDonald's, Johnson & Johnson, more or less their dividend yield, it starts in the 3% range. Okay, you just told me historical long-term inflation is around 3.22. In your first year of investing, when you buy these stocks, inflation rate pretty similar to your dividend yield. And so any money you're getting off that dividend yield, it just kind of gets wiped out. That's how they're looking at it. The reason this is incorrect is they're not pricing in the growth rate of dividends. In a job, again, one gets a raise each year. Real wage growth adjusted for inflation, it's about 0.2% per year. The beauty of investing in dividends is most of the companies I own tend to raise their dividends quite a bit. They raise it aggressively each and every year. The dividends grow. The dividend, it's not just a static amount. Dividend yield may be similar from year to year because share prices tend to rise as dividends rise. But when one looks at the dividends they're getting and their yield on cost, dividends they're getting divided by their purchase price, the yield on cost can go way up. So I want to take two scenarios here that are going to make this concept a lot more concrete and explain why dividends can far surpass inflation. So I'm going to take two scenarios here. Scenario one is 5% compounded. This is a very conservative scenario, but what I'm assuming here is above and beyond inflation, the stocks that I own can grow the dividend an extra 5% per year. So if I believe long-term inflation is about 8% or 3% per year, I need dividend growth of about 8% per year to achieve this 5%, because 8% minus 3% from inflation, that's 5%. Or if I believe inflation is more around 2%, which is actually where I think it's going to be, 7% is what these companies have to grow the dividend each year, because 7% minus 2% for inflation gets me to my 5% adjusted for inflation. Anyways, scenario one assumes that I can get 5% compounded growth after inflation. And we'll get to this in a minute. I think this is pretty conservative. But the reason this works is, look, $100,000 hypothetically invested at 3%, I'm going to get $3,000 in income in the first year in dividends. It makes a lot of sense. It's just 100,000 times 3%, $3,000 I get in the first year. The problem, again, that most people have with this analysis is they think that's it. They think, okay, I get $3,000 a year and that's all I'm going to get in perpetuity. But that is just not the case. When one invests in a dividend growth stock, the dividend raises each year. And so if they're raising the dividend by 5% per year, after 10 years of compounding 5% per year, and this 5% again is after inflation, I'm accounting for it after inflation, I'm getting to $4,654 in year 10. This is a 4.65% yield on cost. $4,654 divided by my $100,000 invested is 4.65. This is the key, and it may not seem like a lot because 10 years compounding starts, it gets much more leveraged in the long term. After 20 years, 7.5% yield on cost. I'm not yielding $3,000 a year. Now I'm yielding $7,581. 30 years out, $12,348. 12.35% yield on cost. The key here is that the dividend grows. It's not static. And the dividend, quite frankly, at a lot of these companies is growing so fast that doing 5% above and beyond the rate of inflation, in my opinion, is not very difficult. This scenario at 1 is not very difficult. And obviously these numbers aren't that exciting, quite frankly, because it takes me 30 years to get to a 12% yield on cost. Am I going to achieve early financial independence doing that? Maybe, but I better have a lot of money to go in from the get-go, a lot of money being poured into the market. And so I have experienced dividend growth rates quite a bit higher than that. In fact, I have one dividend stock, not accounting for inflation, that I'm already yielding 17.5% yield on cost. And I haven't owned it too long. And so that's what's possible with a higher dividend growth rate. Anyways, scenario 2, I look at the same thing, but I assume a 7% rate of dividend growth above and beyond inflation. And so if I believe inflation is 3%, that means the companies would have to grow the dividends by 10% per year. If I believe inflation is at 2%, they would have to grow the dividends 9% per year to achieve these numbers. Anyways, $100,000 at 3%, again, starting yield in the first year, it's just going to be $3,000. $3,000 in dividend income. But if I compound that 7% growth rate on my dividends for 10 years, after 10 years, I'm at $5,515, which is a 5.5% yield on cost. After 20 years, I'm at $10,850, which is a 10.85% yield on cost. 30 years, $21,343, a 21.3% yield on cost. This is why dividend investing works. It works because dividends give the shareholders a raise. They give shareholders a raise at a much higher rate than one would achieve working a job. Again, working a job adjusted for inflation, dividends or income is going to increase on average about 2%, 0.2% per year. That's been the real wage growth, at least since 1973 through 2017. Owning a dividend stock above and beyond inflation, one is not getting 0.2%. One could get 5%. One could get 7%. I'm going to show you in a minute how it can be even higher than that. It can be even higher than that based on some recent dividend increases that I'm personally seeing in my stock portfolio. And so the key point here is one can work a job and keep up with inflation, or one can invest in dividend stocks, get income from dividend stocks, income producing asset that one does not have to go to work for, one does not have to get out of bed early, one does not have to work tirelessly. One has to work tirelessly to earn the money to deploy into dividend stocks, but once the dividend stocks are going, all of those increases, all of those raises, they come compliments of the house. They come from the company. And they come from the company because these companies want to reward the people that own the company. They want to reward the shareholders. So scenario 1 and 2, obviously, these scenarios paint a great picture of doing better than inflation. But what's really happening? What's a reality check here? Let's just look at reality. Well, here's what the reality is in 2018. Starbucks, a company I own, they just increased the dividend by 20%. Let me repeat that. Starbucks just increased their dividend 20 percentage points. 20%. That's a lot higher than what I'm looking at here with 5 or 7% after inflation. The 20% after inflation is 17% if you believe inflation is at 3%, or 18% if you believe inflation is at 2%. Not bad. Let's look at another one. My favorite stock of all time, Johnson & Johnson. Their most recent dividend increase was 7.14. 7.14, that puts them more in this bucket. This is a, they would be about 5% after inflation. Not bad, not great, but it's a reality check. I'm trying to be fair here. And the reason actually I picked the stocks that I'm showing here is all of these stocks are ones that kind of have a 3% plus or minus starting yield in that range. And so they're most comparable for these scenarios where I'm assuming a 3% starting yield. Let's look at another one. Pepsi, my number 2 favorite stock of all time. Their most recent dividend increase was 15%. They raised the dividend by 15%. So yeah, starting yield plus or minus is in the 3% range, but by holding it just for 1 year, or less than 1 year in some people's cases, they enjoyed a 15% increase, a 15% increase in the dividend. And next year, they're likely to raise it again because they have a track record of doing this. Again, 15% year-over-year increase, 15% raise, that's a lot better, much better than inflation. Inflation at 2 or 3%, 15%, it's so much higher than that that it just dwarfs inflation, in my opinion. Another one, Clorox, one of the stocks I've discussed here as well. Just raised their dividend this year, 2018. They raised it by 14.29%. Again, that is somewhere in the range of 11 or 12%, taking inflation into account. Last example is McDonald's. Their most recent one was a 7.45. Reality check, they're more in this bucket. They're kind of like Johnson & Johnson. It's about a 5% or so dividend increase, taking inflation into account. And so the picture I'm trying to paint here, based on recent data at least, is these stocks are at least going to get me in one of these buckets, scenario 1 or 2, and most likely quite a bit better. And when you model this out, go home and model it out in Excel. Model out some of these compound growth rates. It's not very difficult. You can do just use Excel, use the power function. Basically, what I like to do is I'll take my starting like dividend income, like $3,000 per year, which would be what I'm got in this model here. Then what I would multiply by is like a 1.07. The 1.07 takes the 7% growth rate into account, and then I'll do it to like the power of 20. And that basically extrapolates it out for 20 years. Another way of doing it is just multiplying by 1.07, doing it 20 times, carrying it down in a table. And so the beauty of running these numbers, what you'll quickly see, and you even see here, the difference between 5% and 7% is a 12% yield on cost after 30 years or a 21% yield on cost after 30 years. Huge difference. Imagine if it's not 7, imagine if it's 8, 9, 10, or 11. Each percentage point that the dividend growth rate can increase, it dramatically changes the yield on cost when you're looking at very long periods of time. And so what I'm trying to illustrate here is these buckets are conservative in my opinion, but I think it's important to model conservatively because you never know what will happen. If we hit a deep recession, will we see these types of dividend growth rates? Probably not. And so I think it's good to stay grounded in reality. And this is kind of a probable, if not worst case scenario, or these type of scenarios, but a better case scenario may be the types of numbers we're seeing right now with these types of dividend increases. So inflation, yeah, it exists. Will dividends grow quicker than inflation if I pick my stocks wisely? Absolutely. They will grow so much faster than inflation. So inflation, for me at least, is not a big consideration. Now, this is where it gets really interesting. I think what people are just completely missing is they just get fearful because they watch TV, they read the newspaper, they're hearing about these pundits talking about inflation and this and that and politics. It creates fear. That's what everyone's trying to do out there in the media. They're trying to sell news. They're trying to sell newspapers, trying to sell stories, and sometimes it just gets polarized. It gets fearful. And the fact of the matter is, for the average person, in my opinion, especially someone who has achieved financial independence, financial freedom, does inflation really matter? Let me explain this. Something going on right now. Steel tariffs. As we all know, President Trump is enacting some steel tariffs, and those steel tariffs are going to increase the cost of steel. And what's that going to do? If you're out there building a large skyscraper and you need a lot of steel, it's going to increase your costs. What is it also going to do? It's going to create a lot of jobs in the US, most likely, for steel manufacturers. What's it also going to do? It's going to increase the price of an auto, of a car that uses steel, potentially, or metals in the car. So the fact of the matter is, though, when you look at your own life, you look at your cost of living when you're in financial freedom. Are you going to be building a skyscraper? Are you even going to be buying a new car? Or are you going to rely on the car you already own? Or even better yet, rely on public transportation? The beauty of financial independence and financial freedom is life can change. And I'm not even talking about complete financial freedom. Let's say half of your income is covered by dividends and you're able to work half as many hours as you work now because you only need half of your income. With all of that free time, there is so much more time to optimize. We are all creatures of comfort. When time is scarce, it's easy to spend money, and it's easy to spend money for convenience. Let's look at a few examples. More time to cook. I know for a fact if I were in financial freedom, I wouldn't be spending as much money on food because I would be spending more time to cook because I would have more time to cook. This is very basic example, but what I'm trying to illustrate here is I think a lot of these life hacks and life optimizations, not only is financial freedom awesome because it creates more time, but it's awesome because it reduces one's dependency on money. It actually lowers one's budget because one has more time to really think about their expenses. Let's look at another one, public transportation. Or even walking. I know for a fact sometimes I hop in the car just to go a few miles, and I have to do it sometimes because I'm very busy. But I know for a fact that if I had more time, I love running, I love walking, I am all about exercise. It is so core to me. I would leave the car at home and I would walk, and that would save me money. It would save me money on maintaining my car because I would be putting fewer miles on it, and it would save me money on gas. Easy, easy. Public transportation as well. If I'm not in such a hurry to get somewhere, maybe I can take the train. Maybe I can take public transportation. I like taking the train. Sometimes it takes a little more time because once I've reached my destination, I need to walk a little bit more to get from the train to my actual destination. But hey, if I've got a lot of time, boy, wouldn't it be nice to spend some time out there in the community walking around, getting some exercise, breathing some fresh air while reducing my expenses. Let's look at another example. Comparison shop. If I am hungry and my time is limited and I go to the supermarket, for example, I'm just going to buy some food, I'm not really looking at prices. I just grab whatever's on the shelf and I run. I'm a busy guy. Let's contrast that with the day that maybe I have some more time because I'm in financial freedom. I can look at the prices. I can comparison shop. Maybe I shop the sales. Maybe I even bring a coupon into the store. Maybe I take the time to do that. I don't have the time to do that now. I'm able to reduce my expenses because I'm in financial freedom. Let's look at another example. Just convenience-based expenses. There's so many convenience-based expenses these days that one is just paying money for convenience. Good example, washing the car. I love washing my own car. It's one of my things I really enjoy doing because I know I do a really good job at it, better than if I outsource that work. However, sometimes I need to get a car wash. I need to pay an expert to do this work, and it's expensive because I want it done by hand. I don't want my car going through all of those bristles and getting all scratched up, and so it can be expensive. Well, when I reach financial freedom, I can do everything myself. I can spend an entire day washing my car, polishing it, waxing it, detailing it, doing everything that it deserves to look like a brand new showroom quality. And it's going to save me a lot of money because I don't have to pay someone else for their time, and I already own all the products to do that. So these are just a few examples, but the fact of the matter, in my opinion, is inflation is actually not a huge concern for dividend growth investors. And I think a lot of dividend growth investors, especially if they approach financial freedom the right way, can actually experience deflation above and beyond their dividend growth rates, all of that. I'm just talking about budget deflation, cost of living. It can go down. I'll tell you one more, arbitrage, housing arbitrage. Maybe when you're working, you have a bigger home, but once you reach financial independence, you downsize a little bit. You take things a little bit of a more minimalistic viewpoint. This is not for me. I'm not about geo arbitrage or housing arbitrage. It's just not in the cards for me. It's not something that I want to do, but I know a lot of people do that successfully and they enjoy it, and it has deflated their budgets. And so again, this is a point that goes missed completely in this discussion, that dividend investing, what's it about? It's about reaching a goal. It's not just about making a lot of money and having all this money. It's about what can that money do for you. And what the money can do for you is it can buy you time. It can buy you freedom. When you have that freedom, cost of living can deflate. It can deflate quite a bit. And I would argue that it might deflate even enough to completely counteract any inflation that may be coming your way. Putting that aside, though, even on the numbers alone, the fact that dividend stocks tend to increase their dividend each year, at least the ones I own, and they do it aggressively, like Starbucks, Pepsi, Clorox, so on and so forth, inflation, it's just not going to make or break my game, my strategy. And so anyways, thank you for watching. Thank you for the comments, the questions. Look, I invite all comments here. And if you completely disagree with me, please, put it in the comments. Let's have a debate. Let's have a discussion. I don't know everything. I am just documenting my own journey here on YouTube. I've been doing this for a long time. I own 37 dividend-paying stocks, and I've accumulated a lot of knowledge over the time, and I'm real passionate about what I do. But I realize I'm a humble guy. I don't know everything, and so I'm not trying to put down people who disagree with me or people in the comments who have a different viewpoint, because I respect all viewpoints, and I quite frankly respect anyone that's taking charge of their finances, whether it's with dividends, growth stocks, anything, CDs, anything, real estate. More power to anyone who is trying to better their situation through financial investing. Anyways, thank you for being here today. Before I leave today, just want to add a full disclosure. I own the stocks mentioned in the video today, so I am long. I own Starbucks, ticker symbol SBUX, Johnson & Johnson, ticker symbol J&J, PepsiCo, ticker symbol PEP, Clorox, ticker symbol CLX, and McDonald's, ticker symbol MCD. I own those stocks in my personal stock portfolio. Also, before I leave today, a friendly disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Thanks for hanging in there to the end of the video. If you want to support my channel, the best way you can do that is give a thumbs up, a comment, a subscription, all of that. It means the world to me. I'm grateful. I'm so grateful for every single subscriber, because we have a strong community here and we are all supporting each other towards becoming and being the best possible investors that we can be for dividends and cash flow. Thanks again, and I will see you in the next video.